Great. Good afternoon, everybody. Just a couple of minutes behind, but all is well. I see the attendees are shooting up from zero and we're approaching the 100 mark, which is great. With about 170, I think, signed up today. So plenty of interest in this topic. So my name is James Hannigan. I'm an investment consultant at WTW, and I'm also the temporary vice chair for the Finance and Investment Committee within the Society of Actuaries. And with this event today being run as a co-event between the Pensions Committee and that Finance and Investment Committee. So thank you for joining. The webinar is being recorded today, and we do hope to then be able to post it to ActiveView and to YouTube after this event. The Q&A session will also be recorded, so bear that in mind. In terms of Q&A, you can submit questions throughout at any point. The Q&A or chat portal, which should appear at the bottom of your screen. They can also be posted alongside your name or anonymously if you prefer. Questions can also be asked at the end through the raise the hand feature, and attendees can then signal their intention to speak by raising that hand, with the host then being able to unmute you in order to ask that question live. And just a reminder that if you have registered with your full name, the Society will have a record of your attendance. And while there is no longer a need for verifiable CPD from the Society's perspective, there may be other organizations that do require that verifiability. So, standard disclaimer that all the views expressed by our four speakers today are not the views of their employers or necessarily the views of the Society, and they're carried as individuals. So, the webinar today is focused on LDI. Oh, apologies, just here's the competency framework reel, just looking at the different areas that this session covers. So in terms of the webinar today, it's focused on LDI with investments and pensions perspectives. And ultimately, following the UK's gilt crisis in September and October last year, LDI really made its way to the front pages of many mainstream media outlets. It alerted many market participants and also pension stakeholders to some of the potential operational and liquidity risks that must be understood regarding it. Now, this event will consider some of the learnings from the UK's experience, as well as the outlook for LDI in an Irish context, and also the factors that Irish DB scheme stakeholders need to consider. So the speakers today, we have four of them. Firstly, we have covered the Q&A so we can keep on moving through. So firstly, we have Simon Bentley of Columbia Threadneedle. Simon is the Managing Director and Head of the UK and Ireland Solutions Client Portfolio Management Team at Columbia Threadneedle. And he's responsible for the investment outcomes of a range of LDI clients. Simon's worked with large UK and Irish pension and insurance clients, implementing LDI, fixed income, and derivative-based solutions. He joined Columbia Threadneedle through the acquisition of BMO in 2021, having been with BMO since 2011. And before joining the group, has worked at UBS Global Asset Management, Insight Investment, and also Lazard Asset Management. Second up, we have Thomas Donoghue of Insight Investment. Thomas works for Insight Investments and has the responsibility for overseeing the investment management activities with their funds. He's the designated person for the investment management oversight and the Chief Investment Officer for Insight Investment Management Europe Limited. And prior to joining Insight in 2019, Thomas was an investment consultant with LCP and Aon Hewitt. Thomas is a fellow of the Society of Actuaries in Ireland and is an active member of the SAI's Finance and Investment Committee. We also have Deirdre Coyle of WTW. Deirdre is a scheme actuary and a risk management key function holder to a number of large defined benefit pension schemes. And Deirdre also heads up Willis Towers Watson's trustee steering group and participates on the pensions committee for the Society too. And then last but by no means least, we have Pat O'Sullivan from the Pensions Authority. Pat is the actuarial advisor to the Pensions Authority. And prior to joining the authority in 2007, he worked across life assurance and in pensions actuarial consulting. So I'm going to mute myself now and hand over to Simon.
Excellent. Thank you very much, James. So what I thought I'd do to kick things off is just provide a brief explanation as to what we're doing under the bonnet of an LDI portfolio, explain how swaps work, and in turn how leverage works. That's been a very, very key topic over the last 6 months or so. And then take you through what we've seen in the UK market as a starter, and from that, we can look at what happened in the euro market, compare and contrast those two things, and that then takes us on to some of the lessons learned. So if we start at the beginning, you know, what is it we're trying to do with an LDI portfolio? Well, all defined benefit pension schemes have a set of liabilities which are going to be sensitive to a greater or lesser extent to changes in inflation, and also to changes in interest rates by virtue of the way that we discount those liabilities. Now, as those market rates move around, the value of the liabilities moves around very significantly, and we typically refer to the risk of the liabilities moving around as unrewarded risk. You know, it's just inherent in the way that we value the liabilities. It's not linked to an investment decision that we expect to get rewarded from. So the point of LDI is to manage that unrewarded risk and ultimately build ourselves a portfolio of assets that behave in the same way as those liabilities, so that if we see the market moves, you know, like we've seen in the last sort of year or two, and the value of the liabilities goes up or down, the value of the hedging assets moves in exactly the same way at the same time, and literally the two things offset each other, and therefore we're hedged against those market moves. Now, how do we do this? I mean, there's a number of different assets that we can use to achieve this. The most obvious will probably be a portfolio of bonds. You know, we can get inflation-linked bonds, and the price of a bond changes as yields move. So the inverse price-yield relationship, as yields go up, the bond price will fall. But there's a number of practical challenges with implementing a purely bonds-based hedge. The first is actually the availability of the bonds themselves. Pension scheme liabilities go out a long way, you know, 50, 60 years into the future. Not all Eurozone governments issue bonds out that far. And actually the granularity of the availability of bonds isn't that great. But probably the main challenge with using a purely bonds-based portfolio is capital efficiency. Now, if a scheme was fully funded and it didn't have any return requirement whatsoever, then actually a bond-based hedging portfolio would work perfectly well. You allocate all of the scheme's assets to bonds, they match the liabilities, and you know, you've locked down all of those unrewarded risks. But for most pension schemes, that's not my best idea, let's put it that way, because a lot of pension schemes need to take some sort of investment risk to generate some excess return that helps close the funding deficit. If we spend all of the scheme's money on bonds, we've tied up all the capital, there's nothing left to invest in those return-seeking strategies. So we need something that's more capital efficient, that gives us the level of risk reduction that we want, but with a higher level of capital efficiency. And this is where the other instruments come into play, swaps in particular. That's something that's used very widely across liability hedging mandates within the Eurozone. And we can get inflation swaps, whereby we pay a fixed rate to a counterparty, we receive whatever inflation happens to be, and that obviously matches the obligation that we've made to pension scheme members. And we get interest rate swaps as well, which behave like a bond in that we receive a fixed rate of interest, and as the name suggests, we pay a variable rate of interest to the counterparty on the other side. Now, I won't go into too much detail about the precise mechanics of a swap. I think the easiest way to think of how a swap works is it behaves just like a bond, in that its price will go up and down with changes in yields. The difference is that for the bond, you want £100 euros worth of hedging, you have to allocate 100 euros to that bond. The swap is different. The swap is a contract for difference. It has no value on day one. So unlike the bond, whose value will go up and down from 100, it'll go up to 110 and down to 90. The swap goes up and down from a value of 0. So it'll go up to 10 and down to minus 10. Moves in the same way at the same time as the bond, but it doesn't have that underlying capital element to it. And in that way, it's more efficient. And what that means is, because you haven't had to commit all of your assets to the swap in the same way you would as a bond, you've got those assets available to invest elsewhere in some sort of return-seeking strategy. Now, clearly, that is a massive oversimplification, in that you need to allocate some of your capital to support the scenario where the swap might take on a negative value. And this is where the concept of leverage comes in. So, for example, if you were looking at hedging 300 euros of liabilities, you might set aside 100 euros of assets to support the swap. And in that way, you're 3 times levered. That's how the maths would work on that. Now, if we think of typical portfolios, I mean, there's probably no such thing as a typical portfolio. It is very much about tailoring to each individual scheme's requirements. But the sorts of levels of leverage you'll see in the market now, and this is post the UK gilt crisis last year, you're probably looking at about 2.5 times leverage. So 100 euros in is going to hedge maybe 200 or 250 euros of liabilities. However, the point with leverage is, it can be thought of as borrowing. There's always a cost associated with borrowing. So you use leverage to the extent that you need to use it to create that capital efficiency to allocate to growth assets. If you don't need it because actually you're very well funded, you only have a very small excess return requirement, then the leverage gets dialed down. So we run portfolios with quite a wide range of leverages up to the 2.5 that I mentioned, but some portfolios are almost entirely unlevered. It is something that you would tailor to each individual scheme. Now, that creates an additional requirement for not just investment managers, but advisors and schemes to think about, which is just managing that leverage in an appropriate manner. Because what happens when interest rates go up and down? Well, if interest rates go down, actually the value of the scheme's liabilities will be rising. The LDI portfolio will do exactly the same thing. So if the liabilities go from 100 euros to 150 euros, you'd expect the LDI portfolio to go up by the same 50 euros. Now, the opposite is true, and this is what we've seen over the last sort of 12 to 15 months, which is that as interest rates rise, the value of schemes' liabilities fall, and therefore the value of the LDI portfolio falls. Now, what's happening under the bonnet is that the positions we have in the portfolio, which will either be a mix of bonds or swaps, or just purely swaps backed by some cash, is that as the value of those positions is falling, we're essentially settling the mark to market on a daily basis for a process known as margining or collateralization. So if the swap goes to -10, we'll use some of the cash that's set aside to support that swap to basically settle that loss each day. And there comes a point in time where actually that pot of cash is depleted, and it's appropriate to top it up to avoid ultimately running out of assets within the pot. So this process happens behind the scenes. It happens either within a pooled fund or within a separate account or a segregated portfolio. As an investor, you won't ultimately see that. That's something that the manager does day to day. But what you will see is when the portfolio reaches the threshold where it needs topping up, the manager will generally come to you and ask for that top up. So they'll specify an amount that is appropriate to top the pot up by, and a time frame. And then it's up to the client to find the cash from somewhere else, move it across to the LDI mandate and top it up. Sometimes the manager will have their own funds that they can facilitate that sort of switching from and to, but one way or another, the scheme needs to put more money into the LDI account. And this creates a requirement for schemes to think about two things: liquidity on the one hand and governance on the other, because a scheme needs to sort of set aside and know up front where it might turn to get those additional assets to top up the LDI portfolio. And those assets need to be liquid. If it's a fund, it needs to be something that's daily dealt with a relatively short settlement cycle, and it probably wants to be something that's got a relatively stable market value, so you're not exposing yourself to undue market timing risk. And then beyond that, you need to think about the governance model. Do you as a group of trustees have the governance model to move the money around when that call comes? Or actually, accepting you might not have the governance budget to do that, is there a mechanism for delegating that? Maybe to your advisor, maybe to a fiduciary manager, maybe to your investment manager, but whatever works for you. But those are the two important things for schemes to think about. And it is critical that they think about that sort of now, in advance of that call coming, rather than when that call comes. Now, if I can just scroll through the slides here, I'll just take you through what happened in the UK towards the second half of last year. So what we've got on the screen here is real yields, so the net combination of long-term interest rates and long-term inflation, so 20-year gilt yields and 20-year gilt-based inflation. And you can see over really the first 9 months of last year, a strong and consistent rise in real yields. And what that meant was liability values were falling, LDI portfolios were falling. Actually, during that 9-month period, we and other managers were going through thresholds where they were calling additional cash from clients. So far, so good. Actually, that process worked really well. Clients were able to move money around in the time frames that were required. We then got to this point here, which was around the tail end of September, specifically the 23rd of September, where let me say our somewhat misinformed Chancellor and Prime Minister at the time announced their new fiscal policy. I've heard it described as many things. Policy is probably the most polite thing I've heard it described as, which basically involves spending an awful lot of money into an inflationary environment. And what that meant was the market reassessed what it thought the Bank of England would have to do with base rates in response to that. I put them up very sharply. So we saw a very, very quick and significant pickup in yields. Now, if you'd asked me a year ago what a big move in real yields would be in a day, it's probably 15 to 20 basis points. Well, we saw a 50 basis point move on the day of that announcement. And when we came into work the following Monday, so the 23rd was a Friday, we came into work on the following Monday, we saw another move of a similar magnitude. Now, what this meant was a number of LDI accounts would have gone through those thresholds where they had to ask clients for additional capital. Because the market had moved so far so quickly, actually the time frame for needing that capital was materially compressed, and not all clients would have been able to provide it. And the alternative to not providing the capital is that the manager reduces exposure. That has the same effect in terms of deleveraging. And to reduce exposure, you generally sell index-linked gilts. So the act of selling index-linked gilts, makes them cheaper, pushes the yield up. So created a spiral of yields going higher and higher, which is why you can see this line going vertical here. And we moved very quickly over the course of a couple of days to the gilt market being dysfunctional. There's no better way to describe it, where actually a relatively small volume of trades were having a significant impact on the market because the flow was entirely one way. This chart actually understates the situation because it captures the end of day levels. If we'd have taken the sort of intraday level on the Wednesday, actually it would have gone a little bit higher because the market went higher and then came back down again when the Bank of England intervened. Maybe just to put some sort of asset percentages to this, we saw individual days where index-linked gilts fell by 15%. The peak to trough move was about 45% in value terms. So, totally beyond the realms of most people's reasonable expectations here. Now, this first leg down in yields is immediately after the Bank of England intervened. That stabilised the market. Ultimately, they didn't do enough, though, both in terms of quantity and buying the wrong bonds. They initially sought to buy conventional gilts, so just interest rate sensitive gilts, but really the market was being challenged by pressure on index-linked gilts. So we saw this second leg up in yields here, which then necessitated the Bank of England reinforcing their support for the market by committing to buy index-linked gilts. And that then brought levels back down here, at which point actually the Chancellor stepped down and was replaced. The fiscal plans were entirely reversed, and we've seen a period of sort of normalcy from then on, where ultimately the market's sort of reflecting underlying fundamentals. Now, it's worth just comparing this to what we've seen in the Eurozone. So this is a similar chart. It's looking at real swap rates in the Eurozone, and you can see a similar theme here. So real rates rising steadily but gradually over the year. And this is reflecting the fact that inflation has been very high and persistent, and there's been expectations of central banks raising rates, not just in the UK and the Eurozone, in the US as well. That then feeds through into long-term yields. What we don't see is the market dysfunction or the impact of that fiscal policy in the Eurozone. That was unique to the UK. There wasn't any real scope for contagion to other markets. It was UK specific. And so we've avoided the big spikes that were just about here in the UK, and we've seen a far more sort of steady movement. When we look at what's happened in the UK and the response to the gilt crisis, there's been a number of things. I mean, the first one is portfolios across the industry have reduced leverage thresholds to basically give them more headroom, as we call it, to absorb the what we now know of, possible significant interest rate rises that we can see. We and other managers have reflected to what extent you then translate that into Eurozone portfolios, and to what extent are the markets the same and to what extent are they different. And I'd probably call out a couple of things. I mean, firstly, the Eurozone market is far broader in terms of issuance. So in the UK, we've just got the UK government. It's gilts or gilts. In the Eurozone, there's a variety of different highly rated governments issuing into that market. And on the other side of the coin, the investor base is far more diverse. In the UK, our challenge is that, particularly for index-linked gilts, the main holder of index-linked gilts are UK defined benefit pension schemes. So when they will move at the same time, and therefore you get that spiral of yields just moving in one direction. In the Eurozone, with a more diversified investor base, you're less likely, I can't say it's impossible, but you're less likely to get that level of movement. So the general consensus is you bring leverage levels down in Eurozone portfolios. It's appropriate to reflect what we've seen in the UK, but not probably to the same extent. Roughly speaking, you look at our portfolios, we brought Eurozone leverage down by about half as much as we brought UK leverage down. The other thing that clearly is a lesson learned that schemes are re-examining. It's not that they hadn't paid attention to it before, but it's just pushed it to the forefront of people's attention, is that point about liquidity and governance models. Assessing, have you got the right assets sat alongside the LDI portfolio? Is there anything you should be doing to improve the liquidity of those assets? And also, have you got the right governance model? Is there anything you can do to improve the governance around that? I think that's probably an appropriate time to pause, hand control of the slides back, and pass over to Thomas as well, who's going to take us through some of those points.
Thanks a lot, Simon. Good afternoon, everyone. I'm happy to be able to speak with you all this afternoon. So the two topics I will cover over the next 15 minutes, if I can figure out the slides, how to move them on. Yeah, great. Are two things. One, the lessons learned for LDI strategies from the UK gilt market crisis of September and October 2022. And secondly, how and why those lessons are relevant for Irish defined benefit pension schemes in the context of what Irish DB schemes endgame is. I'll do my best to briefly cover the most important points up front to leave most of our time for questions and discussions at the end. So there was a moment last year when some people questioned whether the UK gilts crisis was the end of LDI. And I'm pleased to say it wasn't. And really, the discussion today will look to cover why it's a necessary part of investment and risk management of DB schemes, both now and in the future. And really, over the next 15 minutes, I want to introduce the journey ahead for Irish DB schemes and how we can incorporate some of these lessons learned from the gilt market crisis in September and October 2022. So since the late 2000s, there has been a large-scale shift in the way the pension scheme liabilities were expressed on company balance sheets, as well as substantial rethink by actuaries as to how to undertake liability valuations. And one of the implications of these changes was that a more transparent link was formed between observable interest rates and inflation expectations in bonds and swap markets, and the assumptions used to calculate the present value of liabilities. That is, how much money is required at the current time to be able to meet the pensions promised to members in the future. So market volatility, tougher funding rules, increasing life expectancy, as we know, have all taken their toll over the last 15 years in terms of the perceived costs and risks of providing pensions as they've increased. As we all know, DB plans started closing in greater numbers, particularly post the financial crisis in Ireland after 2008. And since then, there's been a pretty consistent focus to try and protect scheme members from facing further cuts to their benefits relative to what's being promised to them. And over the last 10 years or so, we've seen a material reduction in investment risks taken by Irish pension schemes. These investment risks faced by DB schemes are common to all schemes. So you have the liability risks, as Simon mentioned, which are typically unrewarded. You also have cash flow risks, and you have the risk for the growth assets. And these liability risks are typically significantly larger than the risks posed by the growth and volatility of the assets held by the scheme. And in particular, to hedge liability risks, DB schemes are holding larger allocations to bonds to match liabilities. Now, in a UK context, while rising bond yields, as Simon has shown on his chart over the last 12 months, have been at the heart of the massive liquidity strain that Simon described for UK pension schemes, the picture overall for most schemes is one of improved financial health. So data from the UK pension scheme industry at the end of 2022 shows estimates of around 80% of interest rate and inflation risk, those two unrewarded risks, being hedged. So that is, if liabilities go up by £1, then the hedging assets would correspondingly go up by 80 pence. And these high hedge ratios means that schemes have been well protected in the chart I can show here, the 15 years period of falling yields. And yet, as schemes weren't fully hedged, the sharp rise in bond yields over the last 12 months, as you can see on the furthest right-hand side of the chart, means that liabilities fell in value typically by more than the change in the value of the scheme's assets. And if we look at the private sector UK DB pension scheme universe, these pension schemes are now in a much better funded position, both in terms of the overall deficit percentage. So we think apparently 13% of all schemes have a deficit, that's 13%, and also on the overall size of those deficit, which has pretty much gone to nearly zero, so approaching surplus. Now, what happened after the mini budget on the 23rd of September in the UK was that some pension schemes were unable to react sufficiently quickly to match the pace and scale of the fall in the price of gilts and the requirement to top up collateral pools to support their leveraged gilt exposures. So some schemes were unable to maintain the full amount of hedging within their LDI portfolio throughout the period, or made active decisions in order to revisit the level of hedging and take it slightly lower if that meant that less collateral was required to be set aside. Now, the underlying issue was clearly a liquidity and settlement problem rather than an affordability issue. That is, it was a market event interlinked with the liquidity crisis, but it was not a solvency crisis. By and large, the vast majority of UK pension schemes did whatever they could to maintain their hedges by liquidating growth assets to replenish the collateral pool in their LDI portfolio. The view being they could probably afford to do so because funding levels will have improved. And as we know, UK schemes aren't fully hedged, so that's in 2022, liabilities have fallen by more than the value of the assets. So the schemes had the assets, but the challenge was the ability to transform them into cash quickly enough. So there's a race between moving to bond yields and the time taken for assets to be sold and transferred into the LDI collateral pool. Now, we're certainly aware that this is an aggregate experience. It wasn't true for all UK schemes. Some schemes suffered an economic impact, either in terms of funding level or the size of the deficit as a result of decisions to reduce the scheme's liability hedges at some point in October. However, I'll reiterate that the market crisis that happened in September and October affected all UK schemes, and it was a liquidity crisis for pension schemes. Now, in an Irish context, the most recent asset allocation survey from Mercer at the end of 21 shows the average allocation of Irish pension schemes to bonds is around 58%, so around 60%, it's safe to assume. Now, the first bit of good news is that for Irish pension schemes, by increasing their allocation to bonds over the last 10 years, they will have benefited. So the liabilities are now valued based on asset prices. The scheme can be immunized, as Simon said, around the change in the value of the liabilities by holding the right assets. So bonds and swaps are similar maturity and duration profile. So this means that exposure to bond markets is larger overall, and some schemes have implemented LDI strategies by utilizing some leverage to take a position to build out their interest rate and inflation hedge ratios. And consequently, this means that the remaining assets can be invested in growth assets. That is, things that have less predictable returns, but a higher prospect of producing higher returns in the future. And really, this comes down to what LDI actually is. It's the impact of the cost of funding the scheme's deficit doesn't have to come from company contributions alone. It's using that leverage as a lever to generate higher returns. And this creates the great trade-off of LDI. So if bond yields fall the 15 years up to 2022 on the chart, it means that you receive supernormal returns on your assets to help offset the rise in liability values. However, on the right-hand side, when bond yields rise, you need to sell up growth assets to maintain your hedge to top up your LDI collateral pool. So that's the context. Now, what happened after the crisis? And I've put a lot of bullet points here on the slide. I'm not proposing to talk through them, but what I will do is cover them in the context of the next couple of minutes, and hopefully it'll frame it for discussion and questions. Now, on the left-hand side, in the short term, the main thing that happened is the LDI leverage management processes within LDI funds and the frameworks used by all LDI managers were recalibrated to protect pension schemes and their LDI funds or portfolios if market dislocations were to occur in future. Really, we know it's important to focus on the overall resilience of an LDI fund's exposure within the overall context of a scheme's investment strategy. So investment managers want to make sure that where the LDI fund is within the investment strategy, it remains resilient and comfortable in relation to potentially very large changes in yields over short periods of time. And broadly, it's sensible to hold enough resilience collateral within the fund to support leverage in your portfolio, similar to what we think might happen in the future. Now, that's obviously can't predict the future question, but it's probably sensible in a UK context to protect against similar moves or magnitudes of moves that happened in September and October 2022. Now, we'll come on to the regulatory expectations subsequent on the next slide, and obviously Pat has joined us today kindly to discuss it from a pensions authority context as well. But in the longer term, in the medium term, the right-hand side, for an Irish-specific context, really what we need to learn is what happens to UK schemes. How do we think about what's relevant for Irish schemes? Now, Simon touched on it, and I'm sure there'll be some questions. Obviously, over the last 12 months, we've seen bond yields rise materially. And this means that really the value of liabilities for Irish pension schemes has fallen. But we're now in a world where there's higher yields and there's a higher volatility for yields as well. There's specific lessons within the UK context in terms of supply and demand for UK gilts and the functioning of the index-linked gilt market, and how that supply of UK government gilts will be met in future, where the two largest buyers of gilts are largely full up. UK pension schemes are largely in the surplus position, and quantitative easing from the Bank of England is actually in reverse, with ongoing QT having started in late 2022. So we need to get ready for an environment in the years to come where there are market dynamics in Europe. We don't know what the future looks like, but we also know there's a commonality where the ECB are no longer a buyer of government bonds in any amount at any price. So as an industry, the Irish pension schemes, we should be preparing Irish pension schemes to be ready for that dynamic to play out in the future. Not a similar dynamic to the UK, but a dynamic where there's higher volatility of yields. And if there's a market shock, how can schemes make decisions, and how can we make sure that our pension schemes are very resilient in the face of them? Now, just to set some context for Pat to be able to speak to from the UK regulatory experience and from my day job in Dublin, obviously at the time, in the short term, there's regulatory coordination across LDI funds, either being based in Dublin, inside a specific context. For Simon, I think your company's funds are based in Luxembourg, but there's joined up coordination between the CSSF and Central Bank of Ireland and the FCA in the UK in terms of the expectations of LDI investment managers in protecting funds in the best interest of shareholders. This was also joined up at the time with the pensions regulator in the UK. And really, it boils down to maintaining resilience to a level to be able to support volatility associated with the recent past in the future. Now, pension regulator has some very specific things that it wants UK pension scheme trustees and actuaries and advisors to consider. There's 10 steps that were set out on the time of the 30th of November, where the Central Bank of Ireland issued a letter to the investment management and pensions industries, setting out their expectations for the future. And there's some specific roles for UK pension scheme trustees to undertake in terms of the lessons learned review. So I'm sure we can come on to that with Pat's comments for an Irish specific piece. But really, I think the key takeaway in terms of from now, 15th of March 2023, looking forward, is that there's joint regulatory engagement in this matters. So the Bank of England Financial Policy Committee meetings on the 20th of March next week, and then they're going to follow up with a statement on the 27th of March. Pensions regulators also expected to issue a statement at that time as well. And national regulators such as the FCA, Central Bank of Ireland, CSSF will go through a multi-week process of coordinating their communications to industry participants such as ourselves. There's also a UK parliamentary inquiry and a House of Lords Industry and Regulation Group, which have been undertaking meetings in recent months, and they will have formal communications and findings in due course as well. So very briefly, onto the second part of kind of the meat and drink of the discussion, what is relevant for Irish pension schemes? very briefly cover what specific actions I think Irish pension schemes can take to improve resilience, and also crucially capture the improved funding positions, which thankfully all our pension schemes are in March 2023. So from the lessons learned context of the UK, I think there's three broad headings that we can capture it in. I know Simon's referenced actually the three of them as well, briefly. So we think three headings of liquidity, integration, and governance is a useful framework that we find helpful in our work and discussions with clients. And when I think about last October, I'm kind of reminded of the saying that a team is only as strong as its weakest sub. And I was probably reminded of that because I spent enough years on a sideline in the Midlands in Ireland watching Gaelic football and not being on the pitch that long. But in properly stressed markets, it's the weakest link in the chain that'll break you. So, for example, it's no good having lots of cash, but not having the right governance processes in place to be able to transfer it from A to B in time. There's no good in and no value in chopping up assets into loads of different mandates and different investment managers if that actually creates inefficiencies, costs, and ultimately might lead to adverse outcomes that are avoidable if and when markets change by large amounts in short periods of time. So we now know that some of the best funded Irish pension schemes are approaching surpluses, and how to strengthen those surpluses. We need to think about what can we do about it. But from the context of the UK pension scheme industry, kind of three different things that UK pension schemes can do and Irish pension schemes consider. Now, you can do nothing, that's option one, so leave things unchanged. If you have an LDI mandate, do you really need to change your collateral? Do you need to change your liquidity profile of your assets? If it's a no, after reviewing it, that's okay. But the second option is maybe to put in place a set of additional protections, such as large collateral buffers, broaden the range of eligible collateral, delegate decisions to different people, and the implementation of those decisions. Obviously, there's scheme-specific considerations. Third option is embrace a higher degree of integration in your overall investment strategy. Leave the job of managing the engine of the car to the people that design the car. Focus on the destination of the car if you're a trustee and driving and getting there, and how long it'll take along the journey along the way. So our hope that the discussion today will give you some food for thought in the context of investment and risk management strategies for Irish pension schemes. But I just want to leave you with some very brief comments before I pass over to Deirdre. So we know after the 3% rise in yields in 2022 that Irish pension schemes are very well funded. Latest accounting surveys from Mercer and LTP at the end of the year show an aggregate surplus for the first time in over 20 years, which is great. I'm sure Pat can comment on the level of schemes that are still in funding proposals and how that's expected to play out by the end of 2023 as well. So what's next? If that's now, what next is how do we protect these funding levels? How do we continue to shrink remaining deficits over the next 10 years? How can we strengthen the basis of our actuarial assumptions and our discount rates to get to a position where the surplus is in a least risk possible investment strategy that will be able to run off the pension scheme or buy it out of the insurance company if and when that capacity emerges. So those two things, either continue to run off the pension scheme and pay the pensions as they fall due indefinitely in the future, or pay a premium and buy out the liabilities with the insurance company, and the insurance company covers all pension payments in the future, are the two options. That's what we mean by the end game. So just three questions very briefly for Irish pension schemes looking forward into the future, work in 2023, and I'm sure Deirdre will cover some of these. Number one, do you have a forward-looking investment risk management plan? How do we capture the funding levels improvements in 2022? What's the end game target? Two, does the scheme's assets provide the right amount of liquidity under normal scenarios and stress scenarios? If there's a stress scenario, can we sell assets to short notice? Three, lastly, even if you have those two things, forward-looking plan and the right kind of liquidity, does the governance model that the trustee board and the scheme's governance structures enable quick decision-making and efficient implementation, and thinking that if there was a market crisis and we need to do something in a matter of hours, how practically would we do that? How would media be convened? Where would we get timely access to information? How would it be consolidated? Do we delegate the implementation to specific people? So that's brief. That's it for me. Looking forward to your questions, and I'll pass over to Deirdre now.
Great, thanks very much, Thomas. So hopefully I'll get control of the slides in a minute in terms of...
Oh, that's me, sorry. There you go. Come try and do.
There we go. I think that's working now. Great. Perfect. Okay, sorry. So thanks very much, Thomas. That was really good in terms of understanding, at a high level, the risks and at the detail level as well. So maybe I'll just start with why I consider LDI. And it has already been covered, but I suppose it's just in the context of there's a decision of, do you or do you not engage in LDI? And the obvious reason of why is that interest rate and inflation risk, they're among the highest contributors to pension funding risk. So if you look at any VAR number, they'll be right up there, probably along with growth asset risks if your scheme still has a material allocation to growth assets. As already explained, you're often constrained from using physical bonds. It'd be wonderful to just be able to invest everything in bonds, but you need to agree the funding and therefore the investment strategy underlying that funding with the sponsor. So LDI and an increased hedge can dramatically reduce the risks that arise from inflation and interest rate risks ultimately to member benefits. So I think LDI was always something that would have been a benefit to a scheme in terms of reducing the risks. But the added dynamic that we're seeing in 2022 and 2023 is that many schemes see significant improvements in funding levels from rising rates because they're not currently 100% hedged. And they're exploring LDI to increase the hedge and lock in some of those gains. So when you're thinking about a decision of, should I move from physical bonds and a lower level of hedging to LDI, or should I move from my existing LDI level of hedging to a higher level of hedging? It's always a balancing act. So you're going to be thinking, that we're going to mitigate some risks by increasing my hedge ratio. The very obvious ones are your interest and inflation risk. You're also going to reduce your covenant risk because you're less likely to have to go to the company with a deficit at a future date if you've hedged out those risks. And, obviously associated with those covenant risks are risks to the security, the benefits for the members. If you've got discretionary increases and you've increased your hedge on inflation, you may also support your ability to award those discretionary increases in the future if inflation rises. At the same time, it is a balancing act. You're taking on additional risks. So you're increasing your liquidity risks, and that's been really well explained actually by the previous two speakers. There's a particular aspect in an Irish context that as your hedge level, especially as it rises above a certain level, which is good for your ongoing funding position, you may be introducing some new minimum funding standard risks, and therefore any covenant risks associated with what will happen if at a future date your MFS funding level deteriorates. So when we think about how do we control risk, so if you think about it from a risk manager perspective, first up for me is the increased governance that you're going to need. And the previous two speakers have explained in a lot of detail around the increased governance you're going to need in terms of agility and in terms of preparation. So, you're going to have to do additional preparation in terms of your mandates and changes to your portfolio. And you'll also need increased agility. And what we saw was really marked in the UK crisis was the speed at which things happened, and that emphasized agility. So I suppose anybody who has LDI, they're preparing so that won't be as acute should there be issues that arise in the future, whilst accepting that the UK was an exceptional crisis. So I think there's those elements of increasing your governance, but actually even before those, I think LDI is complex, so there is increased governance required. It's a challenge to understand, and then once you understand it and understand it at a granular level, it's a challenge to communicate. So typically what you see in schemes that take on LDI is that there's an increase in the level of governance. Often you'll use a subcommittee to do some of those deeper dives, those discussions and coordination of your first line of defense with your scheme actuary and your investment advisor, and sometimes the underlying LDI manager as well. And you'll see a concentration on, using trustees with particular skills. So for example, skills in the finance area. Another way of controlling your risks is to include the sponsor in that discussion. Sometimes you have to make a compromise in terms of the hedge that is right for your scheme at a particular time, between MFS and ongoing funding level, and also if you're hedging out inflation risks that relate to discretionary benefits. And It's effectively, it helps to control the risks of an adverse scenario if you've talked to your sponsor in advance around that, because it reduces the risks that, for example, if you decide not to increase your hedge ratio, and if you do disclose a deficit at a later date, if that's been done in consultation with the employee, it will support the more positive outcome from that scenario. The other big risk, and it's been really well covered, is around controlling liquidity. So I suppose looking at it from the other side, from the risk manager or the trustee advisor side, the ways that you're going to have to work to control that risk are you're going to need close coordination with your investment manager and your LDI manager to understand the moving parts and where the risks actually lie. And ideally, I see that being done at an investment committee or a risk committee level. There's some obvious short-term actions. You pivot your portfolio to liquidity. As has been already mentioned, you'll look to daily deal and to have mandates that are up to date. You'll also take some actions around medium term. So what I'm seeing is that schemes are projecting their cash flow outgo over the medium term over a number of years. Some of those elements of cash flow are stable. For example, you'd expect pension payroll to be broadly stable, and some are unstable. So for example, if you have a scheme with large transfer outgo or could have large transfer outgo, and also cash collateral calls, to support the LDI, that will also be an unstable cash flow. So typically you'll want to do that cash flow projection with at least one downside scenario from a risk perspective. And then you orient your portfolio to generate the cash flow that you're going to need to meet those calls. And on a monitoring basis in terms of controlling risks, you'll monitor your collateral headroom. If you're relying on liquidity from other elements of the portfolio, then you need to be aware of that liquidity. You need to scenario test that liquidity continues to be available from those elements. You need to understand gearing and what different gearing levels do to the speed and scale of portfolio change. And you'll want to scenario test collateral calls and ability of the portfolio to respond. So for example, you might prepare a table of different interest rate shocks for different gearing levels. And then ultimately, I suppose what you're doing in the end is you're balancing the gearing that you have, the target hedge ratio that you'd like, and therefore that's the rationale for that level of gearing, and the ability of the portfolio to respond in terms of liquidity to the collateral calls that you could get at those different shock levels. And then you set a tolerance level from a risk management perspective for action, and you consider, I don't think this is an exercise you do once. I obviously it's not something you do once, but you may need to do it frequently. And I think there you'll need to talk to your first line of defense around what's the appropriate frequency level, because definitely what we've seen is that we are in a more volatile world, and you'll have to keep refining your model to reflect the way things are changing in the real world. And I just wanted to touch as well on one of the risks that you need to control, and I referenced it in that seesaw balancing act of risks, is your ongoing versus minimum funding standard risks. And that's a particularly Irish feature. What I've done here is I've just taken a sample scheme, and here we have a scheme with 100% funding on its ongoing level. And then we look at some shocks if rates fall and if rates rise. And here we look at different hedging levels. So for a scheme that has a low hedging level, like 30%, which most mature schemes would have a higher hedging level than that. But if you had a hedging level of 30%, and if, for example, you've got a 2% interest rate fall, your ongoing funding level is going to be exposed to a fall to 79%. Whereas if you increase your hedging level to 90%, what you'll actually see is that the range of outcomes is much narrower. Your ongoing funding level will only fall to 97%. So that's exactly as you'd expect. That's the whole purpose of increasing your hedge, is to remove the volatility that you see here at low levels of hedge ratio to a much narrower fan of outcomes here at high levels of hedging. I suppose what's specific to an Irish context is that your minimum funding standard doesn't respond in the same way. And what you'll see something similar enough at low levels of hedge ratio. So, and when I talk about a hedge ratio here, I'm talking about 30% is the hedge ratio on the ongoing basis. So on the ongoing basis, if you had a hedge ratio of 30% for this sample scheme, and you started out with a core funding level of 108%, as you'd expect, if rates fall, your funding level goes down. And if rates rise, your funding level goes up, you get windfall gains. The peculiar Irish piece is, I suppose, that at high hedge ratios, which you're going to want in terms of protecting your ongoing funding position, what you'll see is if that rates fall, you're going to get a windfall gain. And if rates rise for this sample scheme, your funding level on the minimum funding standard now falls into the red. You've hit 100%. You're going to need to think about how you manage this as you increase your hedge ratio up. The absolute level of your starting minimum funding standard funding level is relevant. So for example, if you had a very high MFS funding level, for example, 150, 160%, you may feel you have enough buffer to absorb these sort of adverse impacts. But even then, you need to set a tolerance for when you need to reconsider that. Ultimately, you're going to decide, what is my journey plan here? Which of these funding levels is my priority, my long-term priority in terms of protection? So for example, if you're in runoff, you definitely want to get it right on the minimum funding standard. And I think here, if you're looking at a compromise, and this picture will be different for different schemes. For example, for a very immature scheme, it will be quite different. For a scheme with a high level of discretionary pension increases related to inflation on the ongoing basis, again, it will be different again. I think a discussion with the company around the compromise that are having to be accepted, the potential consequences for members and for the company later down the line, depending on where the hedge rate is settled. And is there anything that you can do to mitigate, for example, these risks here, for example, contingent assets from the company? So in terms of controlling the risks on the funding basis, typically I think you would prepare a scheme-specific heat map, modeling your interest and inflation scenarios at different hedge ratios and on both the MFS and on the ongoing. And the fan of interest and inflation sensitivities that you look at, I suppose now is quite different than what we would have looked at 2 years ago. So, 2 years ago, a 0.5 or a 1% interest rate move might have been considered big. I don't think it's considered, huge anymore. You'd recalibrate that model after significant market movements. You think about your absolute funding levels and you discuss with the company and you set your tolerance levels. So I'm just going to pass you over now to Pat, who's going to take you through some of the particular aspects that are of interest from the Pensions Authority perspective.
Thanks, Deirdre. Good afternoon, folks. I don't have any slides, so we could probably go back to the 50th anniversary slide. Just a question that Thomas, I think, raised earlier about the current funding position of schemes. There are about 7% of the 500 odd DB schemes are on a funding proposal at the moment. That's 30 or 35 schemes. And actually, quite a number of those are due to finish at the end of this year. But, so hopefully that number will keep declining. Going back to LDI specific, we observed clearly the UK events with quite a bit of concern at the time, but it was pretty clear that the UK position was quite different to the Euro area position. But at the same time, from the Pensions Authority perspective, we did feel that we didn't have sufficient information to make a really good assessment of the position of Irish DB schemes and LDI. We would have needed better information about how many schemes are using LDI, some idea of the scale of the LDI investment and what kind of exposures are there. You probably know that we do have some indicative data from the ADRs, and many of those returns do mention LDI under the other category, much more so the larger schemes. There's probably fairly little activity in the LDI space on say the bottom 300 smaller schemes. But the ADR data is high level data and is not at all granular. So in October last year, we wrote to the trustees of the largest 30 schemes and asked them for information. No, we didn't actually mention LDI in our survey letter because of the lack of an agreed definition, and we don't want to be getting into a definitional debate with trustees about what is LDI or not. What we asked for was the two most recent trustee annual reports and accounts, a listing of margin calls requested of the trustees during 2021 and up to that part of 2022, whether such requests exceeded limits that might have been set by the trustees based on the risk model. We asked for the scheme's headroom, the available liquidity, their capacity to handle calls, and lastly, what, if any, steps the trustees had in view or had planned in view of the UK events. We chose those 30 schemes on size because we felt it was a reasonable survey. The total assets of those schemes is about 50 billion, which is 2/3 or so of the 75 billion total. So the results, 20 of the 30 schemes surveyed appear to be making use of LDI, whether they call it that themselves or not. With a health warning, then the health warning about our estimate of the scale of LDI investment, we would find it difficult to judge that because it's not entirely clear what assets you should be including or not. But in terms of overall scale, it does seem to be something like 10% or 8 billion euro of DB assets are pretty, you might call them LDI assets. Now that percentage varies quite a bit from scheme to scheme. 10 out of the 30 clearly have 0, and of the 20, there were a couple who were above 40%. So that's quite a variety there. The question about margin calls. 10 of the 20 schemes reported some additional margin calls made directly onto the trustees during the period. Now, the scale of those margin calls was in the range of 1% to 4% of the scheme's total assets. So is that big or small? Well, it's not nothing, of course, but it's not catastrophic. One response noted that despite calls having been made, the trustees decided not to meet them. So as I sit here, I'm unclear as to what the consequences of that decision were to the scheme. On the headroom question, the 20 schemes reported an average headroom of 300 basis points. At the time of their writing to us, which would have been during November last year, the range of results was pretty wide. A couple of schemes reported as low a number as 30 basis points, which seems low. But some other schemes reported that they had enough liquidity to support any amount of calls. Then on the more qualitative questions, then as a direct advisors. As regards future plan, one scheme actually mentioned that they had been looking at LDI, but they decided not to go that route, but that they would keep it in mind for the future. At the time, it was possibly a bit early for asking trustees about their future plans, but there certainly seemed to be no evidence of a reduced appetite for LDI. Also, in hindsight, we didn't ask about exposures or leverage at that time. So I think there's scope for some more research on that, on those questions into the future. Just looking at the trustee annual reports, then in the trustee statement of risk, LDI was frequently mentioned, but mainly as a risk mitigation. Only 4 schemes mentioned LDI possible source of risk due to collateral calls. In the SIPs, the trustee statement of investment policy principles, the majority of the 20 LDI schemes, as you call them, the majority of them did mention LDI. We found little explanation in any of the reports of the reasons for adopting an LDI strategy, and very little explanation as to how an LDI strategy works. But it has to be said, of the literal couple of schemes who did include a good amount of material on LDI, well, in my view, it made for a very heavy reading. So actually, the question of communication of LDI strategy to non-experts, I'm sure it could be improved, but it's not easy. As you probably know, actually, where details of sovereign bond holdings by member state are given in trustee annual reports, the holdings do appear to be quite diverse across the EU. Don't result in any kind of a blanket discouragement of LDI, given the wide range of approaches. But LDI is very much a current topic, as I think Thomas and Simon were explaining, and we will be maintaining a watch. To monitor the international developments, mainly in the UK, but also anything from IOPA. We will review the DB financial risk measure that was published in 2021 to see if that should be updated, given what we've learned about LDI in the last 6 months. On the question of guidance or guidelines, to be clear, to the audience who's wide, I think the authority has not issued any guidelines on LDI, and at this juncture we haven't yet decided if anything should be issued, if it would be useful. The main points that would be on our mind would be about trustee understanding, operational issues and governance, points mentioned previously. But at the same time, there may be some data that we could issue that might let trustees know if their scheme is an outlier or stand as regards the rest of the market. And certainly LDI will feature in the authority's engagement with DB schemes, and in particular, the treatment of LDI in the trustees' own risk assessment. That's it from me. So I could hand back to James.
Super, thank you very much, Pat. I understand a bunch of that is fresh off the press to an extent. So thank you for sharing with the audience. So yeah, we do have some questions in through the Q&A. I also do see one hand that I think has been up since relatively early on. So please feel free to submit any further questions or indeed put your hand up and we can come to you at that point. First question is in via the Q&A and I might put it to Deirdre. And Deirdre, the question is, hello, why is the hedging impact different for the ongoing basis of liabilities versus the MFS basis for liabilities?
Okay, so it's basically down to the fact that the MFS basis is not as linked to market interest rate movements. So fundamentally, the two liabilities, I suppose, react in a different way. So if I'll take an example, so if interest rates fall, your ongoing liabilities will shoot up. So let's say they go from 100 to 120. And at the same time, if you're fully hedged and you start off 100% funded, your assets are also going to increase to 120. So you're going to stay with no surplus or deficit. So you're going to be happy on an ongoing basis. What you'll find is that your MFS liabilities will not shoot up by the same amount. So let's say, for argument's sake, that they were 50 to start with. So let's just make the numbers easy. They're not going to go up by 10. They're not going to have the same percentage increase. And that's because although the pensioner liability within the MFS is quite market linked, all of your liabilities in your actives and deferreds, they're not as tightly linked to interest rate movements. And so no matter what you do, you're not going to be able to choose a hedging strategy that purposes both at the same time. So in that scenario, you're reliant on either your MFS funding level is at an absolute level sufficiently high to start with, so it can absorb any of the mismatch that you're about to create on MFS, or potentially the other solution I have seen explored by some schemes is to look at contingent asset, which is only available in a wind-up scenario and therefore is only available for MFS. And that will be in a scenario, I suppose, where the company and the trustees both want, they see their long-term journey plan as runoff, so they do want to protect their ongoing basis, and they want to protect the covenant and the security of the members by preventing any cash calls on the ongoing basis in the future. So in other words, they do want a reasonably high hedge ratio on the ongoing basis. I think for each scheme, you need to look at the little sort of heat map coasters that I had on MFS and ongoing, because it will vary for different schemes depending on the particular characteristics and on the maturity level of the two schemes. Over the very long term, when everybody's a pensioner, you'd expect them to actually, that differentiation will disappear actually, because they'll both be sensitive to interest rate movements at that point.
Great, thank you, Deirdre. A question perhaps for Simon, and this is combining two. So Simon, you said that the market for longer term Eurozone bonds is quite different to the UK market for gilts and index-linked gilts, as there are more diverse buyers in the Eurozone. So aside from pension schemes, who else is buying those bonds? And within this same topic, I guess a question of when the UK pension investors step back, who do you expect to step into that void, and maybe what are the impacts on the market longer term?
Yeah, sure. So, I mean, I'll take each of those in turn. And on the Eurozone side, there's probably two angles to it, actually. I'll focus on the inflation-linked assets, because that was the area of the UK market that really experienced the proper stress. So in the Eurozone, on the inflation-linked side, there's actually less demand from pension schemes than we see in the UK. There's probably only 3 main jurisdictions that would do LDI just by virtue of the way the pensions promise is structured, and that's Germany, Holland, and Ireland. Holland probably being the biggest of those 3 in terms of demand. Actually, again, because of the way the benefit structure is created in Holland, demand for inflation-linked assets from Dutch pension schemes is almost zero. Actually, we don't do a lot of inflation hedging for those schemes. So compared to the UK, where actually most schemes will hedge all of their inflation sensitivity, and they have quite a lot of it, there is less demand from pension schemes in the Eurozone. Secondly, other investors, when you've got the obvious ones, you've got corporates, you've got insurance companies, you've also got more overseas investors as well, just because the market isn't distorted by supply and demand from pension schemes in the same way as it is in the UK. If you look at what inflation pricing in the UK has done over probably the last 20 years, there's been a few bits of research done to look at this. The excessive one-way demand from pension schemes has made inflation pricing look pretty expensive in the UK consistently, and that's essentially what was unwound last year. That same distortion doesn't appear in the Eurozone market, so overseas investors tend to shy away from UK inflation because of that distortion. That's less the case in the Eurozone. And then on the UK side, who is the other side of the trade if UK pension schemes are selling? This was the problem. Nobody was the simple answer. And if you look at the trade volumes during the gilt crisis last year, actually the trade volumes at the beginning of the crisis, when the market was first moving, they were relatively low. Most of the selling happened after the Bank of England intervened because there was regulatory pressure to reduce leverage. Actually, up until that point, the amount of the volume of sales was relatively low. It's just that because there was no natural buyer on the other side, the one-way flow moves the market and it just keeps on moving. Hence why the Bank of England stepped in to ultimately be that natural buyer on the other side and stabilise the market. So I think one of the objectives for the for the DMO is when they're looking at issuing index-linked gilts in future, it is to try and diversify that investor base somehow, so that that remains something to keep an eye on.
Couple of brief comments to add to what Simon said there. Yeah, you just, when Simon says there was no one on the other side, over 90% of the holders of index-linked gilts are UK pension schemes. So that's a very high number. Obviously, in Europe, Simon's made some pertinent comments around demand, but also within the structure of the overseas buying, there's an interesting point around expected currency volatility. So the euro-dollar market's always been large. The demand for euro issuance, including corporate bonds from overseas investors, ex-Eurozone, has always been relatively stable. That's something that's expected to continue. There are a smaller proportion. The Bank of International Settlements has some really good data on any primary issuance, how much is foreign investors, how much is domestic banks, insurance companies, etc. But one thing I think is crucial that Simon said is the proportion of the overall European DB pension scheme market as the overall demand relative to issuance. We can think about it in Irish context. We can think about Irish government bond primary issuance, how much is actually purchased by the Irish DB pension scheme industry. And yeah, I think they're the main things that I want to add.
Great, thank you very much, both Simon and Thomas. Francis Keogh has had their hand up, so if someone is able to unmute Francis to ask their question, that would be okay. Francis's hand maybe has now gone down, so maybe Francis does not want to ask that question anymore, which is fine. There's a question in slightly related, I think, to maybe Pat's comment too, around the one scheme that indicated they had pulled back from considering LDI at that point. And it was a question I was going to kind of put to Thomas around what you have seen on that front. Have you seen clients either in the UK or in Ireland saying, we're done with this, we're out if we already had it, or we're not going to consider this anymore, having been partly down that path?
Yeah, so I made a comment during my presentation a bit, as broadly during the crisis, we saw the vast majority of schemes do whatever they could to maintain their hedge. I think it's fair to say that the vast majority of our clients have reviewed their hedging levels, reviewed their LDI mandate, continue to want to hedge at an appropriate level, a high level, speaking generally. The implementation of that is obviously related to requirements for collateral and also the improved funding position. So how far away from endgame do you require leverage if you're really fully funded, real surplus, hard discount rate, strong basis from a liability valuation point of view? What form does the mandate take? How do you manage your cash flow risks associated with that? That's both in paying pensions and an increasing majority of pension schemes and LDI volatility. So I think it's been in a very small percentage of cases we've seen clients disinvest from LDI. The common thread for the ones that have is that they're so well funded they can be fully physical mandates that are forms of bonds and don't need forms of leverage, but they're in a minority because they're at the far end of the spectrum in terms of how well they're funded. But fair to say every UK pension scheme trustee is reviewing in the context of overall investment strategy and then what risk management means. So sorry, from an Irish perspective then as well, I suppose it's fair to say, as part of your comment, James, and your question, is Pat touched on it. The profile of LDI investors in Ireland is typically larger schemes. Typically ones with those with the investment sophistication to be able to consider investment risk management of liability risks. We've seen that change in recent years. We've seen the priority order for considering liability risk go up the page in terms of decision-making requirement of trustees, given that when you measure the overall euro and cents amount of risk, inflation and interest rate present value risks outweigh your growth asset risks. And similar vein to UK pension scheme trustees, improved funding means what do we actually do about this? How do we do it? There's obviously a difference in the form of LDI implementation, but wouldn't have seen any Irish pension schemes decide that LDI wasn't for them if they'd already allocated to it the last 10 years.
Okay.
But,
Excellent. Thank you very much, Thomas.
Fair to say, to be disingenuous, but I didn't round that out by also commenting on and linking into Pat's comment that there are some clients that decide we don't need to meet this margin call because we're so well funded and we're going to allocate to physical euro government bonds within our mandate, not an LDI mandate. So that's important to say as well. And they're in a well funded position.
Okay. A question in which I might put to Simon. We have about 10 minutes left, so we'll try and get through as many of them now as we can that come in, relating to headroom and collateral. So does headroom more or less determine the collateral that's needed within an LDI portfolio? And how much would have been a typical level of headroom in the UK before Liz and her friends did what they did? And also, again, a similar number compared to what it is in the Eurozone and what it was in the Eurozone maybe before these things kicked off.
Yeah, so simple answer, yes, to the first part of that question. Headroom kind of determines collateral. The more of, and headroom is the amount of market move that a portfolio can absorb before you either have to recapitalize it, or if you use the regulatory definition, the amount of market move you can absorb before you actually run out of assets entirely. The more headroom you want, the more collateral you need in the pot. Simple as that. In the UK, you were probably looking at about, and this is using the regulatory definition, so the amount of headroom before you exhaust the pot entirely, if you don't take any action, you're probably looking at about 200 basis points or 2% of headroom. That's now gone up to about 3%. In the Eurozone, it was probably about the same. It was about 2% of headroom. That's now gone up to about 2.5% of headroom. The one thing I would just call out is the different types of headroom. There's the headroom for your self-contained LDI portfolio. Let's say it's a fund. And I could tell you that that fund will absorb, let's say 3% in terms of market moves before you have to take some action and do something. You then, as a pension scheme, may separately want to decide that you want additional headroom baked into what we call adjacent assets that sit alongside the LDI portfolio. So, you know, that's your liquid DGF, your absolute return bonds, the sorts of things that you're going to liquidate to top up the collateral pool. So there's headroom within the LDI pot itself, and then there might be some additional headroom that you want, and you want to think about how you structure that alongside the LDI mandate.
Great, that's good and clear, Simon, thank you. There's a question here, and I might just put it to the group, as we don't have someone who's strictly from an insurance company. If buying out pensions are the ultimate end game, are insurers willing to accept LDI portfolios as part of that transaction, or do they need to be liquidated in order to be able to buy out the liabilities?
Yeah, answering from like a UK context, in the past, given the maturity of the buyout market, buy-ins, it would typically be, even if you had a segregated portfolio of bonds, the movement of the sensitivity of that asset portfolio to the buyout pricing is important. But typically the insurer will review the assets that you hold and see, do they want them on their balance sheet, essentially. So it's highly on, I think, that percentage. And that's something that's important within investment strategy, that trustees aim to have the right mix of bonds that become, because it matches the pricing. But like, it's rare that an insurer will say, we'll take all the bonds. Obviously within an LDI fund, there's a mix of bonds and swaps. Swaps are not relevant for transfer, they're just closed out. Physical bonds, it's a proportion of government and high quality investment grade corporate bonds from different jurisdictions. And it can be a majority in some instances where there's good alignment between knowing the insurers that will be relevant for speaking with and buyout tenders, and what their profile of assets that they desire is, and the trustee phases into that over a long period of time beforehand.
Anything else from anyone else regarding that point? Okay, excellent. A question here around the idea of collateral and what assets would typically be considered as collateral from a LDI manager's perspective. Maybe Simon, if you want to take that.
Shall I pick that one up? So within the portfolio itself, we're doing the collateralization daily. Depends slightly what instruments you're trading, but it's generally going to be very high quality Eurozone government bonds. That's what we use as initial margin, for example. So that's going to be French, German, Dutch government bonds, and then cash. Simple as that, day to day. So within the portfolio, those are the two things we'll focus on. For pension schemes who are then holding some assets alongside the LDI portfolio, when we talk about topping up the LDI portfolio, you've basically got to liquidate whatever it is you're holding alongside the portfolio. So you don't pass that into the portfolio, you sell it for cash, hence why liquidity is super important. And then we use that cash within the pot directly as collateral.
Yeah, for the first time in the crisis, the Bank of England accepted high quality corporate bonds with an appropriate haircut or discount applied to the par value of them. That was very much for large schemes that had the documentation ability to be able to back on, well, they actually accepted them from bank counterparties, so the bank counterparties would have to have that within the documentation for pension schemes. As an industry, it's been explored. It'll probably, given that high quality corporate bonds are going to make up an increasing proportion of pension scheme investment strategies, likely direction of travel, but it'll be for the largest segregated schemes first, and probably less relevant to Euro LDI mandates at this stage.
Thanks very much. There's a question for Deirdre, just around the interaction that you're seeing between stakeholders in schemes around this area. So obviously towards the end of last year, schemes would have appointed their key function holders, and again, establishing who is doing what is obviously a key part of that. How have you seen the risk manager get involved in these kinds of areas?
So typically what you're seeing is the risk manager there's obviously a risk management framework already in place. So for a scheme that has LDI, there will already be controls in place and monitoring in place. So it's really, and especially as you, I suppose, do a deep dive on the aura, looking at the adequacy of that, talking to that first line of defense as part of your aura. And you can do it in advance as well, in that you probably already have metrics that are being reported possibly currently by the investment advisor, and just making sure that they go into your risk dashboard. So it's just making sure, I suppose that's specifically on monitoring things like cash flow and liquidity. And then it's just supporting the trustees in their, I suppose, their long-term journey in terms of the strategic decisions around what hedge ratio, and making sure that they are getting the right information from all of, again, your first line of defense. And it's probably your investment advisor and your scheme actuary there around something like, the heat map for where is my current hedge ratio, either through physical bonds or LDI as it is now, and what would my situation look like on a different hedge ratio, and am I modeling shocks at the right quantum? The quantum of shocks that we would have modeled 2 years ago are smaller than what we would model now. So it's just supporting really the people who are already doing this, and they're probably already doing it to a high level, and then maybe adding some additional pieces to it.
Yeah, absolutely. Okay, we are coming towards the end. I guess I have one final question that, unless we get another one in, obviously through the Q&A. We've kind of talked about what LDI is, how it works, what to think about when it's in place. Maybe one for Simon, what is the kind of process or like the lead time for making a new LDI investment or an appointment of an LDI manager?
Yeah, sure. So it depends which route you go down in terms of the vehicle you use to implement. You can either buy units in a pre-existing pool fund. You can set up a segregated account where you hold all the underlying positions within your own custody arrangement. Or there's a sort of middle ground where you can use a fund vehicle, but it's set up for the exclusive use of a single scheme. We often refer to it as a fund of one or a bespoke fund. So it looks and smells like a segregated portfolio, but you don't have to have your own custody arrangement. In terms of lead time, you can probably get a pooled fund arrangement up and running in 2 to 4 weeks if you needed to. If you're looking at a segregated or bespoke fund arrangement, you're probably looking at 1 to 2 months, that sort of time frame. And I guess the things to call out that are unique to LDI, different to a traditional manager appointment, would be you need to do some liability analysis, so design a solution. So we will work with the actuary, with the investment advisor, will analyze the scheme's liabilities, look at the interest rate and inflation sensitivities, and map those onto a unique blend of our pooled funds. If it's a pooled fund solution, if it's a segregated or bespoke solution, we'll use that analysis to create a liability benchmark against which we'll manage those underlying positions. There'll be a bit of dialogue around that, make sure we've interpreted the actuarial assumptions correctly. We're looking at the liabilities in the same way that the trustees are, and so forth. Once that's bedded down, you've then got a transition piece as well. Often, I mean, sometimes we'll be taking on a portfolio from another LDI manager. More likely in the Irish market, we'll be taking on a portfolio of bonds. So the scheme will have some Eurozone government bonds, and it may be appropriate to transfer those into the mandate in specie. So there'll be a little bit of work lining up the most efficient way to do that transition, so that you minimize any out of market risk, because those bonds are providing some hedging in the first instance. We don't want to lose that hedging, have a gap, and then reinstate it, and also just minimizing transaction costs. So those are the bits that are sort of unique to LDI that you wouldn't necessarily get in another context.
And James, I might just add to that, just as a front end piece to that on the governance piece, if LDI is new to your scheme, I think you just need to factor in time, just in terms of managing stakeholders and everybody getting up to the same place, appointing subcommittees to explore what's the right strategy for the scheme. I suppose your trustee board becoming comfortable with the concept, and then going just probably, I think in nearly every event, you're possibly discussing that with the company as well, especially if you're significantly changing the risks of the scheme in a good way, hopefully, obviously, but exploring any compromises that you need to make. That can take a while as well.
Yeah, absolutely. We're at 2 o'clock, so just want to wrap things up here and say a very big thank you to Pat, to Deirdre, to Thomas, and to Simon, and also to Ger Nolan of the Pensions Committee for his help in organising this event, and also to the team at the Society as well for their support in getting it going. I think one of the key things that's been said by everybody multiple times is the word governance. And again, it's about really ensuring that you have that right governance in place to be able to do these kinds of things if you so wish. But again, that's no different to any other type of investment or funding or covenant related decision that schemes, trustees, and sponsors get involved in. So with that, we will close the event, and thank you very much.
Thank you.
Thanks, everybody.
Thank you very much.